The Fed has spoken, but did Jay Powell put it all out on the table, or are there more tea leaves to read? Plus, what's next for the economy, and what does that mean for your portfolio? A conversation well worth your 10 minutes right now on UBS Trending. Hello, everyone, and welcome to another episode of UBS Trending. I'm Anthony Pastore. I'm sitting here in the studio today, luckily, with my friend and colleague, Christina Hooper from Invesco. Christina, always a pleasure to have you. Thanks for being in.
It is great to be here. Thank you.
It couldn't come at a more opportune day, I think, in my opinion, as I love to talk about these things with you. We just had a Fed meeting, and the decision, as we know by now, was for the Fed to raise rates by 25 basis points. There was a little bit of what are they going to do going into this meeting, but it seems like maybe, and this is in your opinion, I hear, that they probably made the right decision for now. So tell us a little bit about what you mean by that.
Absolutely. Really, the Fed was following the playbook that we saw from the ECB last week and really the BOE before that, which is handle your mini crisis with targeted policy, but don't alter your monetary policy path. So we got a rate hike because if we hadn't gotten one or we got a cut, I think that would have screamed, this is a real crisis, you should be worried. But we didn't get that 50 basis point hike that was expected a few weeks ago, which really would have been overkill in my opinion. And the 25 basis point hike was a dovish hike because it came along with guidance that this might be the last hike, or maybe we have one more.
Right.
So in my opinion, the Fed nailed it, and I rarely say that.
And I don't think you're alone in that particular statement. I think, as we always say, Jay Powell and the Fed have a very tough job. And as we've been saying a lot lately, there's so much going on between post-pandemic, China reopening, before that, of course, supply chain issues, and then inflation just being on a whirlwind ride. So it's been a tough go for them to figure out the right place to take the economy. And clearly, they're still data dependent. So what is the data telling you right now, and what is Powell looking at?
Well, the data is telling me there are some really strong parts of the economy, right? But these are mostly lagging indicators like employment. And then some of the data is suggesting to me that conditions are tightening significantly, and we have to worry that they tighten more just given the banking issues. And what's really hard is that even though the Fed is very much data dependent, what they really need to be doing is looking out ahead, and it's very hard to do, to make decisions based on incoming data, concurrent or lagging, is a real problem. It's kind of like that one-hit wonder, the movie Bird Box, where poor Sandra Bullock was blindfolded, bumping around trying to find her way. Except imagine a Bird Box 2 where she actually has to perform surgery. What the Fed is doing...
That's a challenge.
Yes, but that's what the Fed's doing. It's performing monetary policy surgery with a blindfold.
Blindfolded. Yeah, and it's funny, I actually loved one of the things that Powell said in his press conference yesterday, and I want to talk about this with you. He said, in relation to the question about a soft landing, he said the pathway is there, but I'm still trying to find it, which essentially means what you're saying.
Yeah.
He feels blindfolded, doesn't know exactly where to go. What are your thoughts on a soft landing or a hard landing, as we're always asking?
So I still think there's a possibility of a semi-soft landing. I will not go so far as to say soft, and sorry to conflate cheese with the economy, but I do believe there's still a pathway because the job market is so strong. That really is a big differentiator in my opinion, and we are seeing a disinflationary environment. So hopefully we get there, but we just don't know because monetary policy lags are long and variable. And the typical lag is 12 to 18 months. So we just don't know how much damage the Fed has done thus far that hasn't appeared yet.
Right, and as we know in the statement, they added that jobs are running at, quote, a robust pace. So clearly that is a huge piece of data that they're consistently looking at, which of course we all can understand why that is the case. And unemployment remains low, but they say, look, inflation is still elevated, and it's going to be difficult to get to that 2% inflation target that the Fed has.
Right. They have, I mean, I feel badly for Jay Powell. He has the ghost of Paul Volcker hanging over his shoulder. But this is a very different inflationary environment, in my opinion, although obviously there are some similarities in that we've been in a persistently high environment. You know, he's divided up inflation into goods inflation, housing inflation, and services ex housing. What he's worried about is services ex housing, and of course a lot of that has to do with the labor market, but it is a lagging indicator. So I hope that he's tolerant about services ex housing, and is comfortable with the pace of disinflation this year, because we're not going to get anywhere near that 2% inflation target this year, but I think we're on our way, and certainly what we're seeing in terms of tightening conditions is going to help us get there.
That's right. And of course the questions remain, will they pause before the next meeting or do another 25? Will they pause before the end of the year? Will they start cutting rates? Some swaps, the traders are out there saying there may be some cuts. Obviously, there's a lot of speculation. Any thoughts on what we might see as the year progresses, Christina?
Well, if the mini crisis is really in the rearview mirror, I think we might get one more rate hike and then what they'll call a conditional pause. That will be pulled from the Bank of Canada's playbook, which enacted a pause, but very much a conditional pause that is data dependent, so it has some teeth in it.
Right.
I think the Fed wants to try very hard not to cut rates this year, but again, those monetary policy lags are long and variable, and if it's done a lot of damage to the economy and they realize that later in the year and they cut, and they're forced to cut then.
That's right. And Powell said also in his press conference, if they need to raise rates higher, they will. Obviously, it seems like he wants to try and keep things at least steady through the rest of the year. So obviously, with the blindfolds on, it's going to be difficult for even us to know where his and the committee's thinking sits right now. All right, Christina, so before we wrap up, obviously, one of the great things I always get from you is your investment ideas when we're speaking to our viewers out there. And one of the things that we have here from our Chief Investment Office is our message and focus on seeking income opportunities. They believe that investment-grade corporate bonds are a real good place for that. What are your thoughts on some investment recommendations?
Well, we tend to be actually very in sync with the CIO office most of the time, and I agree completely about investment-grade credit. I mean, let's face it, we went through a lot of pain last year with rate hikes, but where we are today with fixed income is arguably something of a golden age, right? There is a lot of yield out there, and we haven't seen it for a long time. And investment grade looks very attractive. It's important to focus on quality in this environment, and you can do that and still get solid yields. So to me, that's an important component of a portfolio when you're positioned defensively, and even as we get to a more risk-on environment, I think that can still be an important component of investors' portfolios.
Terrific, Christina. Thank you. Any other ideas that you've got? You know, we're looking at treasuries. Obviously, yields have come down a little bit. The treasuries are rallying, especially off the backs of the statement yesterday from the Fed. What else is in your kind of mirror as you're looking, well, actually not the rear view, if you're looking through the windshield? What's ahead of you when you see investment opportunity?
Well, one area that's really exciting is emerging markets, both equities and debt, although I would focus in particularly on Asia EM. There's a lot going on with China's reopening that's positive, and the data we're seeing continues to support the view that we came out with last year, which is that China could be a really interesting opportunity for 2023. And it doesn't have to be China equities. Asia EM is likely to benefit significantly from that reopening.
Terrific. Yeah, we had one of our colleagues here recently talking about reopening, and his family still lives in China, and he says his family is going on revenge travel. After 3 years of being locked in, they cannot wait to get out.
And I actually call it revenge living, because it's not just travel, it's eating out, it's doing all those things that you haven't been able to do.
Even simply shopping at a grocery store, which was very difficult to do for the last 3 years in China. Terrific. Thank you, Christina. Always a pleasure. Great to see you.
Thank you.
And thank you for your insights. Great stuff.
Thank you.
And for more information from anything coming out of our Chief Investment Office or great partners like Invesco, you can visit our website at ubs.com/views. Plus, there's a lot of great content up on our social media sites, including our newly relaunched UBS Trending Instagram channel. Check that out. It's our UBS Studios dedicated social media area. You've got great content up there, sound bites, and lots of other important information to help you in your investing decisions. And as always, if you have questions about your portfolio, please speak with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.